Canada Goose put out some amazing guidance in their investor day just a couple of days ago, and the investment community as a whole rejected those numbers and sold the stock down. But in my case, I'm actually buying, and so I'm going to explain all of that to you in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now, if you guys are not familiar with Canada Goose, recall that they are the parka maker out of Canada. And here's a picture of James Bond wearing one of their parkas that they've produced. I guess this was an official ad of theirs. Now, they also sponsor Drake. They have a Drake line as well. This is a very popular jacket. I don't know a lot of people who don't own this brand. That's how popular it is in the country. And the thing about Canada Goose is that they are so primed for growth because most of their, a quarter of their sales are still from Canada, which is an economy that's so small relative to the US and the Asia Pacific region. I think that they have a lot of room for growth. And so the story that they're trying to tell is that they're going to try and get to that level of growth, realize their potential, but the market is not giving them any credit for that. And so let's dive into this a little bit more to give you a little bit better of an understanding. So recall guys that they did have their investor day just a couple of days ago, and what they're saying is that they are guiding to 3 billion Canadian dollars of revenue. So that's 2.3 approximately billion dollars of US revenue. My models are all built in US dollars for as many companies as I can. The Canada Goose model is also built in US dollars, and so in US dollars, once again, that's 2.3 billion dollars. Now, to put that into perspective, they have not even hit $1 billion of revenue. So in around 5 years, they expect to hit 3 billion, and they haven't even hit 2.3 billion. So more than doubling their revenue, and they haven't even hit even just 1 billion yet. And so it seems very high reaching, and you can see that the market is not giving them credit for it. So the other thing is they want higher adjusted EBITDA margins at 30%. I think that they can get to this number. I just think this is the hard part. Now, I will show you guys, at least in my modeling, that you don't even need to hit this number. I undercut it by a lot, and I still think that the company's a reasonable opportunity in this environment. Now, none of this is to tell you to buy the stock or not buy the stock. That's not the point. The point of this channel is just to provide really solid, good research and hopes that you guys could either agree with it or disagree with it, and let me know in the comments below. And so here's how they're going to get to those goals. So they're saying that they're going to accelerate their consumer focused growth. And so the way that they're going to do that is they're going to try to capture new customers with a focus on women and Gen Z. And so that's fine. But here's the real way that they're going to build it out. So they're going to build out their direct-to-consumer network. In other words, they're going to open up new stores. And so they're going to try and more than double their retail footprint from 51 stores that they currently have to over 100. And so that's going to create a lot of the opportunity. Now, also, when you're going direct-to-consumer, you keep more of the margin, because if you're selling through a wholesaler or selling through other stores, they have to keep a piece of that margin. And so of course the sales are not as profitable to Canada Goose as they otherwise would be. So the direct-to-consumer network makes a lot of sense. A lot of you home viewers, you guys know that this is a similar strategy that Nike is doing, and it caused Foot Locker shares to decline, and it actually gave us a wonderful opportunity last year where we bought up Foot Locker on the cheap. In fact, that was one of the biggest winners of the portfolio. In fact, we had a lot of winners last year, but that was one of the bigger winners in the portfolio last year. Now, they are also trying to create new opportunities in categories such as rainwear, apparel, and footwear. I was talking to my wife, and she said that their rainwear and their apparel stuff could potentially be really good. I don't really know about the footwear and the eyewear, luggage, and whatever. However, if you read the media reports, they talk about the eyewear almost exclusively first, because they're kind of painting the picture that they can't expand their line, and really I believe that they can. You go into the rainwear, you go in basically fall clothing and spring clothing. Well, now you've covered 3 of the 4 seasons. I think they win if they do that. And here's the numbers that I was discussing earlier. So you can see that $3 billion guidance is effectively, translated at 1.3 is $2.3 billion in US dollars. Obviously I put $2 signs there. There should only be one, of course, but it's 165% growth of the top line in 5 years. So that's very, very ambitious. And notice here, this is what I was saying, that they haven't even achieved $1 billion of revenue even in the last year. And that was a good year for them. They grew by 21%, which is, some of the highest growth that they've seen. In fact, actually, that's a lie. They've seen much higher growth. But, as the base gets larger, it's hard to grow the company at a compounded rate of 20%, which is effectively, they're trying to even grow higher than that rate to get to that $2.3 billion of US dollars of revenue. And so I don't know if they get there. I'm definitely not forecasting it. Now, on this slide, you can see that they provide a little bit more context on their long-term financial outlook. So they're saying that the revenue rate that they're trying to target by fiscal year 2028 represents a CAGR of approximately 20%. And you'll see in my model that I'm giving them around 12.5%. I'm not giving them 20% at all. But here's how they expect to get there. They're saying that the growth is expected to be driven by an acceleration of the consumer-focused growth initiatives, the build-out on the direct-to-consumer network, and the creation of new and more rapid expansion of existing categories, as they described in that previous slide that I showed. So in other words, they want their stores to be more profitable, so higher sales per square foot by expanding the times at which consumers would want to shop there. So in other words, have a spring collection, have a fall collection as well, not just a winter collection. And then of course add stores as well. And of course I missed this part here, which is actually their focus on focusing more on women and Gen Z as well. And so that's kind of what they're doing, and we'll see how this plays out. Now, when they're looking to build out those new stores, notice that they want an equitable split between North America, EMEA, and Asia Pacific. However, when I show you their growth trajectory, you can see that they're focusing on growing most of their new stores in the European region and the Asian region. And when it comes to increasing their profitability, notice that they're essentially just saying that, their increased scale is going to provide the company with a more profitable enterprise as a whole. And so let's see if they're able to do that and continue to grow at their high profitability. Look, the company is already insanely profitable. Of course, if they're just selling more product, it's just more revenue to cover the overhead that it takes to run the business as a whole. Now, you are going to have to make more investments. You are going to get more overhead, but the contribution to that additional overhead should more than offset it. And you can see here that they guided to $1.2 billion in revenue for fiscal year 2023, which I do believe is a stretch goal already. And so, when you're going from 1.2 to 3, that's how they get to their 20% CAGR mark. But I'm looking at their actual revenues, not their forecasted revenues for 2023 when I'm looking to build this out. And of course, you can see that part of the way that they want to get there is focusing on the direct-to-consumer model. So, by the end of 2023, it's about 70% of their revenues are coming from the direct-to-consumer model. And then, of course, when they get to the end of 2028, they want to ensure that 80% of their revenues, so the vast majority of their revenues, are coming direct to consumer, which of course would increase margins. And of all the slides in the presentation, you can see that, it's a really big presentation. Slide number 145, I think, is the most important, because what it shows is that this is their walk from fiscal year 2023 to fiscal year 2028. And notice that the biggest piece of that is the new commercial initiatives, which of course is expanding their store network in existing markets. And then, but there's other pieces to this that won't get them all the way. So, they have to, in other words, what they're telling you here is that a large chunk of this is just organic revenue growth opportunity. So one, increase the store productivity. So in other words, they want to create a year-round product. And so in other words, increasing the traffic to the stores, which is of course that providing the spring line and the fall line at least, and the footwear might cover them over the summertime as well. Focus on e-commerce, and the way that they want to increase their penetration on the e-commerce front is create a customer-led journey that will create higher conversion. And then finally, on the wholesale level, which they still need to expand their wholesale, which is kind of crazy if you think about it, because they're trying to focus on direct to consumer as well. But the areas where they are going to continue to use wholesale networks, they need to optimize the distribution, and actually they have a buyback strategy of key markets. So wherever they have wholesalers where they want to be direct to consumer, they're going to try and buy back those markets. That's how they get to that $3 billion. So there's a lot of work that essentially needs to be done over the next 5 years. And it's not just a let's open up stores to capture more revenue. There's a whole bunch more here that needs to be done on the organic revenue growth front. So because there's a lot of things that need to be done, there's a lot of things that could be done wrong or missteps. So that's why I think, you have to be careful when you forecast out revenue. Now, I'm not as pessimistic as the market is, but I still am somewhat pessimistic, and I don't think management would like that I'm forecasting at, closer to 10%, whereas they're hoping that we forecast out closer to 20%. And so this slide really speaks to the thesis that I made in the last video that I put out on Canada Goose. And so effectively, they make a quarter of their revenue from Canada, which should not be the case considering the size of Canada relative to the other markets that they're in. And so you can see that in order to get to the $3 billion of revenue, they want to quadruple the number of sales in the Asia Pacific region. They want to 3x the number of sales in the European region, and they want to double the number of sales in North America. And so how do they get there? Well, of course, the largest area where they want to grow, the Asia Pacific region, they want to continue to build out in China, and they want to focus on these particular regions: Hong Kong, Macau, Taiwan, and of course Australia. And so they want to deepen their retail presence in these areas, and they have a strong brand strength. And so, in the European region, they want to continue to grow out their store base in key cities as well as accelerate the women's business. And then in North America, they want to move west. So right now, it looks like they're using wholesalers on the west end of the continent, but notice that they're saying that they have a quest to go west. And so it looks like they're going to create more direct-to-consumer opportunities by creating more stores or opening more stores in the west side of that continent. And so that's how they're going to achieve this revenue figure. Now, jumping right into exactly how they're growing out that direct-to-consumer channel, so in other words, their store growth, notice that they're saying that they're going to increase the number of stores in the Asia Pacific region by 3 times. They're going to increase the number of stores in the European region by 3 times, and they're going to increase the number of stores in the North American region by 2 times. And so they're looking to have 130 to 150 stores, so almost triple by the end of 2028 from fiscal year 2023's ending number of 51. And so, these are very ambitious plans. And, like I keep saying over and over again, that things can go wrong when they do this. And, we've seen retailers do this before in the past and miss the mark. And so this is why I think largely the market is not giving them the credit that they're looking to get here. Now, I really love this slide because, it's a lot of detail. You can see all this detail here to show a 2% increase. So you go from 68% gross margins to 70% gross margins. But I love how they show that they've thought of a ton of detail. And this is the type of management that I'd like to partner with, because they're saying that, their pricing power is going to more than neutralize the inflation costs of their raw materials. Their scaling of higher margin geographies will help offset other challenges as well. And of course, they're saying that some of their new products will actually be sold at lower profit margins. And so how do they keep the overall gross profit margins up for the company? Well, part of that will be scaling. Part of that will be the shift to direct to consumer, and once again, pricing. And so they're showing you how they're getting there. So, some people might have raised a concern where if you go into other product categories, won't this be lower margin products? Well, they're showing you how they're sort of addressing that. So I love the detail here, and it allows me to forecast this out very confidently with gross profit margins in the 70%. That is something that I've completely bought into. And when it comes to their adjusted EBIT margin growth, notice how much of large of a pie the improvement in the operating leverage here is. And I would love for them to give us more detail, but here's what they've provided. They said operating leverage delivered through focused approach to cost savings and realized benefits of earlier stage investments. And so this is a little bit of detail. I would love a lot more detail here, but you can see that the direct to consumer expansion, this makes a lot of sense as to why the profitability would increase. Same with the store productivity. I don't know what the difference between the store productivity and the operating leverage is. One of you guys could let me know in the comments below. Wholesale growth, I guess I can see why that would increase your EBIT margins as well. But, I just want to know, because it's such a big piece of the pie, what am I missing here? And so this is the model that the Patreons get access to at that lower tier, that $5 a month tier. And so as much as I am a shareholder and someone who absolutely loves the Canada Goose brand, I am not giving them that $2.3 billion in sales by fiscal year 2028. Notice that I'm giving them 1.7 billion. I even think that 1.7 billion is a stretch goal, but I think they can do it. In terms of margins, I slowly brought them back up to that 70% profit margin by 2027, or sorry, gross profit margins. And so, I think that they can probably get there by 2027, 2028. They probably will get there sooner. I just thought that the gross profit margins in 2022 were very high, and I think that they will come down in 2023. And so that's why I'm forecasting this the way it is. Notice that this 948, this is actually just the US guidance that they've provided to us. And notice that the operating profit margin is slowly going up. And the reason for that is because I'm bringing their SG&A down as their sales increase to give them the economies that they were looking to get there. And so, this actually might be their operating profit margin or operating margin that they were discussing in that previous slide that I missed. It might just be this, just the greater scale is making them more profitable on the bottom line. That actually might be it. So I just figured it out in real time as I was recording. And so the question is, what is this company worth? Well, I've already told you guys that I think it's pretty valuable, even just forecasting them out at 12.5% growth. Now, one of the things that I have been doing is I've been selling cash secured puts on this opportunity. I've been telling the Patreons what I've been doing. None of it is ever a recommendation for you guys to do what I'm doing, but the Patreons already have access to this model. They know where I'm valuing the company, and if you want access to that model to see what I'm valuing this company at, I believe that it's very attractive, and so you can get to that valuation at this lower tier of the Patreon. And of course, if you want to join us for an epic live presentation every month, you can join us at this higher tier. Now, I recently just put out a video on another company that I thought was pretty valuable by the name of Thor, and if you guys haven't seen that video, you can hit this link right here.